Everyone, hello, my name is Adam and I'm a trader based in the city of London, if you don't know me. So based in the city of London, fund trader, trading my own capital, trading regulated funds. And what I would like to kind of talk about today are, there's actually a lot more and I might cover them at a later stage, but I want to talk about misinformation and disinformation that every single trader who kind of comes from the outside gets caught up in. And so today I'm going to start busting these myths. This is things that I think, a different perspective on things, but also things that I think flat out are kind of wrong, and I want to cover those. I could talk forever, so I'm going to break this down into multiple videos, but each one is worthwhile paying attention to because some of them might mean more to you than others. So basically the idea here is busting 5 trading myths. These are things that traders, I think newer traders, really need to learn to ignore. So it might not mean anything to you today, but if you're in the beginning of a journey, or maybe you're struggling to achieve consistency, then this is going to give you something to think about. Okay, so let's have a look at this. So again, as I just go through this, a little bit about me. I'm based in the city of London. I'm a trend-based trader. I'm technical. 99% of my trades are based off technical information. My returns are generally 50+% per year, or 20+% per year if I am trading 0.25% per trade. So, you know, I've got those returns, and I'll talk about those in a different video on a different day, but I'm trend-based trading. I trade every single market, and I think it's really important to do that. The next thing that I want you to take into account, or I want you to think about this stuff, is what is a trading strategy? A trading strategy is basically a written description, a text description of a visual pattern that has been identified and that occurs on a frequent basis on a particular instrument or in the financial markets, and that if it is executed faithfully, it is just much more likely as a pattern to unfold in our favor than go against us, basically. And so we need to understand that that's really what we're doing here. We're looking for patterns in the markets, and they generally will unfold one way instead of another, and therefore we are navigating that. We are putting our entry on the one side of it, our stop loss on the other, and taking profit as it goes. All right, so we need to understand that's very important as traders. So on the agenda, kind of for this one, this is part 1. So these are 5 trading myths that need to be busted. And if I cover another 5, I'll do that at a separate stage. But these are starting points. So the purpose of this video is for the beginner traders or anyone who's been messing around for a couple of years, not really achieving consistency. I've met people that have been doing this stuff or these things for 10 years and aren't really any way different. And so it's kind of with people like that in mind that I'm inspired to produce this video. So the first one that I'm going to talk about today is the lower time frame. So sorry, the other graphics on the thing is really just to give you a bit of background about my credibility, who I am, speaking at major events. These are clients of mine. I do a lot of work with Trade with Precision, forexvox as well, mentoring and a few other things, but these are my ongoing clients, and this is kind of, these are who I provide market analysis for. So the first one is lower time frames are more profitable. Okay, and so this is a myth. There is this myth that somehow if I trade the 1 minute, if I trade the 5 minutes, this is where all the professionals are trading. This is where I'm going to make my money, and this is what everyone else is doing. Okay, and it just isn't the case, right? So first of all, many new traders believe that they should be trading the 1 minute. It's not meant to be 50 minutes, it's meant to be 5 minutes. So that's awesome. 50-minute time frames in order to become successful, or that all the other professional traders are trading these time frames. So you just assume that city traders and all these different are trading the 5 minutes. There are reasons why that isn't necessarily the case, and I'm going to talk to you. I will take you through that in a moment. And the other one being that these are the time frames that are therefore crucial to success in trading. It's false. All right, it's bull. Doesn't make sense. Let's talk about why. Okay, so first of all, the markets are much more volatile on lower time frames. You have to understand that the market is operating in layers of investors and traders and transactions that are taking place for different reasons on multiple time frames as a result of different analyses. And so we have, let's take the currency markets, for example, Forex. You have banks, hedge funds, large institutions that have got positions they intend to hold for a month, 3 months, 6 months, regardless. You might have a carry trade, so you've got interest rate differentials between central banks. And excuse the gear, I've just kind of been done my exercise for the day, so I want to record this now. So to go back to the topic at hand, they are their transactions are going to hold for weeks. They might even scale in or scale out as they go, because they might have a position that's worth 10 million or 100 million or 150 million euros, or those are examples. And so slowly but surely the kind of the bigger fish have different timelines and different reasons. So they might be thinking longer term, they might be hedging, it might be kind of like a futures approach where they're looking to hedge their positions, for the quarter, for example. Or they might be trying to benefit from a carry trade, which is less likely these days, but there we go. And so you've got that range of transactions. On the much lower time frame, the daily and the weekly, you've got tourists exchanging money. You have got companies that are paying suppliers in different countries. So if you're Apple, for example, or Google, you've got offices in the UK, offices in the US, all around the world. You've got to pay your staff salaries. You've got to do a series of different things. Those transactions are also being exchanged into local currency. Banks also have to hold on to local currencies as well. So you've got that happening. You've got tourists exchanging money. You've got people sending money back to their families. They're working abroad. Australians working in the UK sending money back to Australia. Parents whose kids are doing a gap year in London from Australia, they're sending money to the kid in Australia. There's lots of transactions happening on a different basis. People who are buying property, people in the UK, for example, buying property in Spain, they've got to transfer the money at a certain time. They'll hand that transaction over to a specialist company, which happens to be Global Reach. It's actually not a sales pitch. It just happens to be that's a company that I know that does deliverable FX. Their job is to make sure you get the best rates in that situation, and that can save you the cost of your kids going to college, or a house, or not a house, but a car. And that could be significant. It'd be 10 grand. It could be 100 grand. So you really want to make sure you do those transactions correctly. But my point is, there are layers of transactions happening for different reasons, with different price targets, and so not everyone is on the same side. And if you think, well, I'm just getting taken out by the big fish, that's another one we'll talk about at another day, but that's also junk. Really, the big fish have to compete with other big fish. Mainly they have to deal with each other because their transactions are on such a large scale that they can only do their transactions at key levels where other big fish are coming in. Because you can't get out of a trade or get into a trade unless there's somebody else of the same kind of budget as you. That's how the market works. So on the lower time frames, you also have algos. So then everyone's like, well, algos are driving the market. And actually, that's not necessarily the case. One of the things that you need to remember is that algos and computers trade noise really well. They trade it far better than humans ever will be able to do that. But they struggle with trends, and humans trade trends can outperform computers on a regular basis. And that's because visually, at a glance, we can see what the conditions are, but a computer doesn't really see things the way we do. So at this point in time, maybe when AI starts picking up, then that might be the case. But if at some point AI are competing against other AI, it's not really going to go the way everyone thinks it's going to go. We need differing or different opinions about the markets in order to make the markets beneficial for people. So the noise on the lower time frames is traders, it might be investors, it could be big fish unfolding a longer term position. There's all kinds of things. And then maybe there's a bit of a news spike, or maybe there's a certain amount of information released, and all those things that take place on a daily basis. So the point being, the markets are much more volatile on a lower time frame. The market conditions and the direction can change multiple times per day, especially with currencies. And I'm using currencies because everybody thinks that that's where, you think that's the shit. And it's not. The markets can honestly, they can go from an uptrend to a downtrend to ranging to an uptrend to a downtrend several times a day. And beginner traders are not really kind of in the loop on that. For most of them, nobody's ever said to them, the market trend is going to change multiple times throughout the day. They don't know that. And so, of course, then on top of that, you get random spikes that are due to insignificant noise. This is today, so the chart on the right-hand side is literally sterling today. This is cable. And this is a couple of different spikes today that are apparently due to, Brexit wrap-up stuff, or maybe some kind of stimulus packages or anything kind of tied to that. That's caused this. But predominantly sterling is weak. So maybe today it's just going to take a breather, and then tomorrow it's just going to resume the trend. So you have to understand that there's a prevailing trend and there's a shorter term time frame, and that's the lower time frames. So newer traders who have the least amount of experience are going to be thrust or choose to get into the craziest markets and then expect somehow that that's where they're going to build up their skills while they're getting repeatedly kicked in the nuts. And that's kind of not really what you want. So think about it like this. It's your very, very first day driving a car. Literally your first day getting in the driver's seat of a car. And it's a stick shift for the Americans, and it's a gears for pretty much everyone else on the planet. So you're going to have to learn how to handle the clutch and change gears, and you're going to drive. Okay, so usually what happens is our parents or somebody who's looking after us will take us to an open parking lot or a field or somewhere where there's no other traffic, no other distractions. And first of all, teach us how to change gears and how to steer the car. Because this is all like, it's like, you know, rubbing your belly and patting your head. It's like, that kind of a activity. So you have to learn how to do that. And the very first time that you have to get on the highway, when you've been learning how to drive a car, you've got to remember to hit your indicator, check your blind spot, make sure your seatbelt's in, and monitor traffic when you change lanes. You're shitting bricks because this is such a big, significant moment. And so and your brain has to process a lot of new information that it's never had to do before that. Then you cut to 5 years later, when you are driving home from work and you realize you got home and you've been zoned out. You've been thinking about other stuff completely, but you drove home during peak traffic and you didn't even have to think about it. So it was muscle memory. So it's the same for traders. In the beginning, getting onto the 5-minute chart when you're a new trader is the exact same thing as on your very first day of driving, getting onto the highway during peak traffic. And somehow thinking that's going to be good for your driving experience. It's not. It's a bad idea. Obviously, the idea being that over time, driving the car becomes muscle memory, and then you can focus on other things. And so your brain can eventually start to process more and more complex information at a greater speed, because it doesn't have to do the other stuff. It doesn't have to do 50 different calculations. It only has to do 2. Okay, so there's also exposure to all economic calendar news increases, more things to watch out for. You've got to look out for low impact, medium impact, high impact news stuff on everything you're related to. And actually, no matter what you're trading, you've got to watch the US news, because the US economy is the biggest in the world. So if the US market has a big reaction, it's going to impact everyone else. Lower timeframes also have a greater cost per trade ratio, which means that your spread relative to your candle size or your trade size is usually much bigger on the lower timeframes. I might be looking to get in above and below a particular candlestick. The candlestick could be 5 pips in size, but my spread might be 2. So next thing you know, I've got my stop loss 2 pips on the other side of the candle, my entry 2 pips above, and so that's a 9 pip kind of candle, of which 4 of that, which is almost 50%, 4 pips is just kind of my entry and stop loss and spread being taken into account as a cost, because it's a cost of your trade, and the candle itself is 5 pips. But when you're on the 4 hour, and you have maybe a 25 pip candle and you've got 2 pips above and below, the ratio of the spread that you had to, or of the buffer that you had to add in on either side as a percentage of the candle size, and therefore as a percentage of your trade size, is much less. It's almost insignificant. So you need to be aware of that. That means that it means that a 5 pip candle is actually not your trade size. It's a 9 pip candle, and you have to therefore go 9 or 10 pips into profits beyond your entry to kind of then start to get to break even. Okay, so that's important. That's a factor. It's just a factor that we have to be aware of. So the other thing we need to be aware of is that the market moves faster at these levels, at the 5-minute, 1-minute, 10-minute levels. Information is coming at us. It can be contradictory. It can go sideways. We can get a bullish candle. The price action itself means less. It has less weighting at the lower time frame. So that means an indecision candle or a bullish candle on the 1-minute time frame is not necessarily as significant as it would be if it was on the 4-hour time frame. Okay. And also, the difference between brokers, price action, the candlestick shapes can actually change depending on the broker because of just the way the market works. Forex does not go through a central exchange, and therefore a 1-minute candle could be 2 or 3 pips different between brokers. This is the reality of the situation. It's not even in the control of the brokers per se. And so you could get an indecision candle with one broker on the 1-minute time frame and a bullish candle with another broker and a bearish candle with another, just because of the difference between a 4 or 5 pip difference in the way they close or a 2 pip difference change the shape of the candle. So you need to understand that changes price action. Whereas that is almost never going to happen on the daily or 4-hourly time frames, and therefore price action signals are more reliable on the higher time frames. I didn't even add that in here, but that is important to know. It also requires more experience and time in the markets. So you need time to be able to build up the ability to process, the muscle memory to be able to process all the stuff that's going down, and to gain the necessary reflexes to respond appropriately to the high speed of market traffic, which is exactly what I was saying. And this can lead to gambling, because you become emotionally invested. You are getting kicked in the nuts repeatedly on a regular basis. You keep going, is this something that I can learn how to do? Is this an achievable skill? Am I a good trader? Am I a bad trader? And so this messes with your head. It becomes much more emotional. It is higher risk from that perspective because it's more volatile. The market is moving a lot faster. You also end up moving your stop loss. Do I go with a wider stop loss? Do I go with a tighter stop loss? Do I end up just taking it away and people forget to take profit? So all these really not helpful things, and I'm being polite here, tend to suddenly find themselves happening when you wouldn't do those things on the higher time frame, because the market wouldn't be behaving with as much volatility, and therefore you wouldn't be reacting the same way. So too much of this, then also the problem is then you end up taking 10 or 20 or 30 trades in a day, and often you're taking trades just to make up for losing trades. So you're kind of trying to compensate. So that's also not something that happens on the higher time frame. And now you're just distracted from what your original goal is. And your original goal, ladies and gentlemen, is to learn how to make a secondary or primary source of income from the financial markets, so that you're either recession proof or that you can pad your retirement fund or whatever. But you get distracted because now you're just fighting the whole time. So too much trading disables that healthy progression. So just be aware of that. So what am I supposed to do then? Okay, so you're a beginner trader. You're like, well, okay, that's all cool, Adam, but what am I actually supposed to do? Slow things down. Okay, so just give yourself 1 to 3 months to master that 4-hour time frame, maybe the 1-hour time frame. So in other words, what you're doing is you are slowly exposing yourself to faster moving markets, slowly. And as you're doing that, the price action will become more volatile. But in principle, it should continue to follow. The 1 hour should generally be going in the same direction as the 4-hour. So the idea being that if you master the 4-hour and then you go down to the 1 hour, but you're aware of what the 4-hour is doing, you're likely to trade much more in line with the prevailing trend where the momentum of the market's going. And therefore, you're, in terms of probability, much more likely to have more success, which in turn is going to increase your confidence and you're going to calm down. So in other words, don't expose yourself to the crazy. Just kind of step back a bit. And you have more time to assess a trade setup. A candle will form. It'll take 4 hours or an hour to form, and it has more significance, and then you can trade around that. Also, your spread and everything will be slightly different there. So then I have someone saying, well, I've got a very small account. So that's a possibility, but you really should be able to trade a 1 hour, 4 hour chart. I mean, you might still get a 12 pip candle, but at least this time around that your spread is a much smaller proportion of that. So that you learn to relax and think more. And I should actually have said, instead of saying act less, I should have said react less, because you do find yourself reacting a lot. So you're on the back foot in the beginning. Focus on trending markets. There's a big difference if you look between this slide here on the right hand side, you look at all these different crazy, this is normal. This is very common and very normal. And most of you, if you know what I'm talking about here, this is what you're experiencing on a regular basis. This is where I want you to be trading. This is what you should be looking for something that kind of knows where it's going. It doesn't mean you're never going to have losing trades. It just means you're going to have fewer losing trades, but at least you're going to be on the right side of the markets. And don't counter trend trade this. Trade with it. Go with the market. Okay. So focus on trading markets. Avoid medium and high impact charts around those times. What does that mean? It means if I'm going to trade dollar Swiss and it looks good, check and see if there's any high impact US dollar news or any high impact Swiss National Bank, SNB, or CHF news coming out for the day. Ideally within the next 6 candles. So that's an approximation. That within the next 6 candles. So if you're trading the 1 hour, that'll be within the next 6 hours, ideally. At least enough for you to get a break even. Taking profits, 1-to-1. Take some money off the table 1-to-1. This is important, what I'm about to say now. Pay attention. When we make profits in trading, it isn't to make up for past losses. That's not what it's for. Making money now is to pad our accounts against future losses. So think of the ants and the grasshopper kind of fable, or the idea that you are going to harvest your food during the season to help see you through the winter. That's the way to do it. You can't go, well, it's making up for the last winter. You can't go back in time. So your emotions in your brain will be much healthier if you are forward looking and not holding on to the past. And that just applies to life in general as well. And don't trade without stop losses. All right, every successful trader, one of the factors that has led to their worst experiences ever has been taking away that stop loss. Don't do it. Your stop loss exists with the sole purpose of protecting your existing capital. So don't mess with it. Okay. So your next steps. All right, so do me a favor. Click subscribe to this channel. About half of my viewers are not subscribed. So the reason I'm asking you to do this, and the reason everyone else does it, and it annoys the hell out of me, but the reason I'm asking you to do it is that it elevates my content, so that my content gets more views, which actually makes it worthwhile for me to actually produce the content. Otherwise I'm just going to stop doing it. So do me a favor, subscribe to it. But also, if I do a live stream, which I do several times a week, you won't know about it unless you're subscribed. So do me a favor, click subscribe, link to that. Secondly, do me a favor and like 2 of my videos that you like, 2 of your favorite videos, including this one, hopefully. Again, the 2 work together. Subscription and liking videos will boost my viewership, which will make this whole thing actually worth my while to do. And then here's a really cool thing. So I'm going to make it worth your while. If you can get 10 people to do the same thing, even if they don't care about trading, you get 10 people to like my channel, subscribe to my channel, like 2 videos, I will give you 2 30-minute mentoring sessions. So you find me 10 subscribers, I will give you an hour's worth of mentoring. Okay, that's a really good deal, because that's worth a lot of money. So you find them, get them to like it, and I'll be happy with that. And that's it. So you can find me obviously on YouTube, Trade All Markets, some good content there. You can find me on Twitter. I'm the most active on LinkedIn and Twitter for my posts, and pretty much everything is on these 3 channels. I'm not on Instagram or Facebook for now, but I will be. That's it. I hope you found this instructive and useful. I'm going to do the others, but now you can understand why I had to break it down into multiple parts, because each part requires an in-depth explanation so that you can understand why it's important. Okay. Thank you very much.